US stocks fall as traders wait to see just how dovish the Fed chair will be at Jackson Hole. The Reserve Bank of New Zealand is set to cut rates, and Malaysia's exports face headwinds. That's coming up in our 5 Things in 5 Minutes on Wednesday, August the 20th. And in our deep dive interview, ANZ Commodities strategist Soni Kumari analyses the gold price outlook.
We hold positive view on gold in the second half of this year with ongoing uncertainties around tariff, macroeconomic conditions, and geopolitical developments continuing to support having demand for gold.
But first, in 5 and 5 with ANZ, US stocks were weaker overnight, led by falls in large tech stocks like Nvidia, amid a lack of economic data. It wasn't one-way traffic, however. The Dow earlier hit a record high. Traders in general remain in wait-and-see mode ahead of Fed Chair Jerome Powell's Jackson Hole speech on Friday night. ANZ Head of FX Research, Marja Bin-Zaman, says direction from Powell on where US rates are headed will be crucial.
He could just come out and say, yes, data kind of firm. He might just firm up the September cut that everyone is expecting, or he could be a little bit more dovish in stating that suddenly the picture has changed. And if you remember, back in September last year, the Fed eased by 50 basis points because of jobs data.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.6% and the Nasdaq was down 1.3%. The US 10-year Treasury yield was down 4 basis points to 4.298%. Gold also down 0.5% at $3,362 an ounce. West Texas oil futures down 1.6% at $62.39 US a barrel. The US dollar index was flat. The Aussie dollar, though, was down 0.5% to 64.59 US cents. And the Kiwi was down 0.3% at 59.01 US cents. Number 2, the Reserve Bank of New Zealand is widely expected to cut its official cash rate by 25 basis points to 3% later today. ANZ New Zealand Chief Economist Sharon Zollner is watching for guidance on where rates are headed next.
Pretty much everyone is expecting a 25 basis point cut, and it would be fair to say it would be an enormous surprise, and you'd probably see quite a market reaction if we were to see anything else. And that's because decoding what they said in July, they gave a very clear signal that they would be cutting this month unless there were any unexpected data surprises. And on balance, we think that the data does support their view that more easing is appropriate. And indeed, we think they ultimately will end up easing more than they are currently forecasting.
Number 3, the last data out before the decision in New Zealand was the Producer Price Index for the June quarter, where input and output prices both rose 0.6%, well below the 2 to 3% moves in March. Here's ANZ Senior Economist Miles Workman.
So where we did see some interesting information come through is the sectors that we know are quite sensitive to interest rates, particular construction. So construction prices on an annual percentage change for both input and output prices sort of running well below their post-pandemic peaks and around about their lowest level since about 2016. So certainly evidence here that some of these industries that are quite sensitive to monetary conditions are seeing disinflationary forces playing out.
Number 4. ANZ's Roy Morgan Australian consumer confidence was steady last week at 89.4. ANZ economist Maddie Dunk says confidence among renters and mortgage holders improved, while it declined for outright homeowners.
One of the interesting things that we have seen is really this gradual movement upwards since May in consumer confidence for both renters and people who are paying off a home loan. And on a 4-week moving average basis, confidence amongst mortgage holders, it's at its second highest level since May 2022, which was when the RBA first started increasing the cash rate.
Number 5. Malaysia's exports rose 18% in July from a year ago. That was above expectations and above the 11% rise in imports. ANZ economist Arindam Chakraborty says export growth to the US has been strong but appears to have peaked.
Going forward, Malaysia's export outlook faces headwinds. The implementation of US tariffs beginning August and efforts by the Trump administration to stop the rerouting of Chinese exports through third countries could weigh on performance. On the other hand, public capital spending is expected to stay strong, which should keep import demand elevated. So on balance, we see this lowering the trade surplus over the coming months.
Arindam Chakraborty there. Now, in today's deep dive interview, I spoke to ANZ Commodities strategist Soni Kumari about ANZ Research's latest outlook for the gold price and what's been driving the market.
The latest announcement on new tariffs by the US suggests that trade-related uncertainties are likely to stay, and the effective US tariff rate has risen to around 20% from just 2.4% and cannot completely rule out further increases. So while, the Trump extended a pause on the imposition of tariff on Chinese goods for another 90 days, this also means uncertainty will linger for at least another 3 months. So we believe these evolving policies could dampen global growth by disrupting trade flows and worsen geopolitical tensions if retaliation from affected countries escalate in the second half. And not only that, the support could also come from easing monetary policy. So market expectations around Fed rate cuts have increased after the recent non-farm payroll and inflation print, while we expect another 3 rate cuts in this easing cycle, and lower rate cuts are normally supportive for non-yielding gold.
Now, in the last few weeks, there's been some drama around the prospect of tariffs on gold bar imports to the United States. What effect did that have on the premium for COMEX in the United States, that version of the gold price, over the London spot price?
Right. So recent confusion over tariff on gold has created fresh volatility in the market. So a ruling by the U.S. Custom and Border Protection Agency stated that 1 kg and 100 ounce, which is nothing but 3.15 kg gold bars, were subjected to tariffs, which were previously thought to be exempt in April. And this created confusion in COMEX gold market, where 100 ounce is the most commonly traded contract. And this led to a widening in future price and the spot price of London. And this led to increase the spread to 100 per ounce. And this was similar even what we witnessed in early this year. While the spread narrowed down to 50 per ounce after President Trump announced that he would sign an executive order to clarify any misinformation.
So the other source of demand has been central bank purchases. What's happened there, and what do you expect in the second half?
Bank gold buying has moderated. Actually, it fell 21% year on year to 415 in the first half of this year. But if you look at the volumes, they stayed 40% above the historical average. So this slowdown is also linked to the fact that higher gold prices lifted the share of gold in the total reserves. And many countries have reached their target of the share of gold to their total reserves sooner than expected. And we believe that fragmented geopolitical landscape, trade tariff uncertainty, a broad de-dollarization trend will see central banks continuing to increase their gold holdings.
And what about demand from other investors and also physical demand for jewellery and for electronics?
For the other demand, higher prices, like for jewelry, higher prices are weighing on these fabrication demand like jewelry and electronics. But the strong investment demand has been compensating for these physical demand losses. So if you look at gold-backed ETF flows, saw a strong inflows across regions with global gold holdings, ETF gold holdings increasing by 397 tons in the first half of this year. And this was the strongest first half flows since the record-breaking flows we saw back in first half of 2020. Coming to, retail investment in bars and coins, that also stayed healthy at 631 tons in the first half of this year, which was the highest since 2013. So while investment demand has been strong so far, they are still well below their peak in 2020.
And so all up then, what do you expect the gold price in US dollar terms to be by the end of the year?
So we expect prices to consolidate in the near term. Like in September, we have price target of USD 3,500 per ounce, but prices should move towards 3,600 per ounce by the end of this year as investment case for gold still remains strong.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, August the 20th. Catch you tomorrow with analysis of the Reserve Bank of New Zealand's rate decision later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.